Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Daybreak Asia podcast. I'm Doug Krisner. It's proving to be a mostly positive day for equity markets in the Asia Pacific. We had some strong tailwinds from the U.S., where equities advanced on the bet for a Fed rate cut next month. Let's take a step back and look at some of the issues that have been driving the price action across the Asia Pacific, and many will continue to do so. Joining me now is William Bratton. He is head of cash equity research for the Asia Pacific at BNP Paribas. William is joining from our studios in Hong Kong. Thank you for making time to chat with me. As we both know, we're nearing an end of the year, and for the most part, markets have had to digest a tremendous amount of information over the last 11 months. I'm curious to get your take as to where we are in terms of relative clarity, if I can call it that. How much more do we have in the way of understanding?
Primarily on the tariff side. Certainly going into the beginning of this year, there was a lot of uncertainty as to where tariffs would settle, particularly US tariffs with respect to the the big Asian exporters. We may not like where they've necessarily settled, but they've definitely come in, we know where they are, right? So that's removed a degree of uncertainty in terms of what the forward looks like. From a corporate point of view, the visibility on the impact of tariffs is becoming slightly clearer. So the challenge that they had going into the beginning of this year was actually that nobody really knew how tariffs either would be implemented or how they would flow through the supply chains. So the reality is, as of now, corporates do have more visibility on the impact of sort of higher costs and how it sort of filters through the supply chains. Is it perfect? No, it's not. Is there still a degree of uncertainty as to what the end costs will be, or the end impact will be, is a better way of putting it? Absolutely.
Does that cause companies to kind of look to alternatives outside or away from the U.S., do you think? Is there maybe an impulse to become less dependent on the United States?
Well, unfortunately, there's a broader sort of challenge that corporates are facing, certainly here in Asia. And the challenge is this whole sort of decoupling of the US and China. So ultimately, corporates are starting to look at the way that the US is sort of enforcing its view of the world and the way that China is enforcing its view of the world. And corporates are having to think now about whether they make a binary choice. Do they basically go with one of the economies over the other? Or do they sort of run duplicated production systems? Do they have a part of their business that's geared towards China and a part of their business that's geared towards the US? This is a real problem for Asian corporates, right? Because if they side with one country over the other, US over China or China over the US, or that not side with, but they gear their systems or their production towards those economies, then they effectively forego revenues in the other market. And if they decide to run sort of parallel duplicated networks or production systems, you actually end up losing economies of scale and incur higher costs. So the whole of Asia, the whole of sort of the Asian export system, including both corporates and countries, are increasingly caught in this binary choice where the long-term outcomes are not particularly positive. So what's happening is that lots of corporates are sort of trying to do as much as they can in the current system. But longer term, there are definitely concerns about the way that the global economy is evolving and the subsequent impact on production costs and relative competitiveness across much of Asia. And that's sort of a longer term sort of profound challenge facing the region going forwards.
Can we bring artificial intelligence into the conversation? And I'm curious about the way in which the technology is being adopted by these firms and whether or not there is an advantage. Maybe they're seeing greater productivity, or maybe it's too early to know.
Oh, I think it's far too early to know. The way that most corporates are now thinking about AI and advanced technology is more around cost control and the ability to sort of get cost efficiencies moving forwards. But I still think most corporates around the region are still working out exactly how to maximize the impact of this new technology. The immediate winners are those who are supplying, the infrastructure, whether it's chips or the other sort of supporting infrastructure. But in terms of the buyer, it's still, there's still some uncertainty as to what the use cases are and how the use cases improve profitability going forwards. So there's a lot of unknown still, which is sort of complicating the whole sort of AI narrative. The clear current winners in the near term are very obvious. Those exporters into the US, particularly into the US tech ecosystem. But in terms of users and the buyers of technology, I think lots are still trying to work out how to utilize it to achieve longer-term gains.
What about the level of confidence or maybe conviction that China will ultimately begin to engineer products that can rival what a company like, let's say, Nvidia is able to produce? Is there still that type of betting going on right now, or do you just basically conclude at this point in time the U.S. has that technological superiority, and until China is allowed greater access to those advanced semiconductors, the U.S. has the advantage?
Across the board, the West has tended to underestimate the ability of China to close technological gaps. So across the board, there has been a consistent tendency to assume that the West's advantage in technology can be sustained and maintained going forwards. The reality is that depending on how you slice and dice it, China has closed the gap in numerous technologies and is ahead in many. Now, there are some where China is still clearly lagging the West or leading edge Western technologies, however that be defined. And chips are one of them. But I would strongly recommend that people don't assume that gap is maintained. I think China is moving incredibly quickly to close the gap. And you talk about advanced chips. The reality is that China does not want any dependency on US technologies, in the same way the US doesn't want dependency on Chinese technologies. There's a clear drive in both countries to put a clear technological separation between themselves. And even if there is an opportunity to acquire Western chips, I'm not convinced that there would be substantial demand out of China for those chips. The reality is that China wants to have its own technological system. It wants to have its own leading edge technologies, and it's closing the gap across a whole slew of technologies at an incredible pace. And just repeating this point, if I go back 10 years ago and I think about what people were saying about Chinese tech and how quickly or slowly they would take to sort of replicate or replace Western tech, China has consistently surprised to the upside. It is easier to identify techs where they haven't closed the gap than it is to identify techs where they're now not at the same sort of leading edge or even actually ahead of leading edge technologies. They're at the forefront, if that makes any sense.
It does. And as I'm listening to you, it seems like more evidence of further decoupling. But I want to pivot right now because the conversation began with geopolitics, and we've got a situation right now between China and Japan that seems to be a little tense after the Japanese Prime Minister Takaichi commented on Taiwan. And I'm trying to get the sense of, from a market participant, what this really means and whether there is an inherent risk here that we need to explore.
So the problem being slightly grey-haired is I've seen this happen multiple times before. The reality is there's always a residual tension between Japan and China. We have these flare-ups on a sort of periodic basis. I wouldn't, from a market point of view, I wouldn't read very much into it. It's basically, both countries trying to, define the boundaries as the sort of political boundaries between them, each of themselves. So I wouldn't, at this point, read too much into the current flare-up. We've seen it before. We've had them. We've had these kind of spats before. Usually they calm down after a period of time when China or Japan has made its point, and they sort of stabilize. There is a broader geopolitical issue, though, which is longer term. China's relative positioning within Asia will continue to strengthen, will continue to get more pronounced. Its influence and control within Asia will continue to grow. And this definitely presents a major challenge for the rest of the region's more minor powers who have to navigate a change in balances of power, basically, and which country has the influence. And over time, over the next 5 to 10 years, our view is that China's relative sort of influence within Asia, and it will continue to grow. It will become more, the scale asymmetries it has will become more pronounced. The US and the West will get more displaced over time. And for countries like Japan and South Korea and others, this is a major sort of geopolitical challenge that they have to navigate over the next 5 to 10 years.
William, we'll leave it there. Thank you so very much. William Bratton is head of cash equity research for the APAC at BNP Paribas, joining us here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Prisner. The latest U.S. economic data further cemented bets on a Fed rate cut next month. We had the delayed report on September retail sales, and if you don't adjust for inflation, we had an increase of just 0.2% after several months of much more robust spending. And at the same time, more current data from the Conference Board showed consumer sentiment at the lowest level in 7 months. And the reading on consumer expectations from the Conference Board over the next 6 months is now at its lowest level since April. Joining me now for a closer look is Jim Worden. He is the CIO at the Wealth Consulting Group. Jim, thank you so much for making time to chat with us. So we had a rising equity market in the States. On Tuesday, the S&P picked up around 0.9%. Healthcare clearly out in front, while information tech was weak. And it seems as though the market is still going through some type of rotation. Is that the way you see it?
Yeah, it certainly feels like a rotation. When I look at my screen, I have a screen that shows all 3,000 of the Russell 3000. There's a lot of green, not a lot of red, but that doesn't look like what the indexes would indicate, right? When we see the numbers, the percentage numbers, especially with Nvidia being a very large weighting in most indices. So this is something that it's almost like two markets within one. Obviously, the news on Meta buying chips from Alphabet is kind of, the market's a little, I believe, overreacting a little bit when it comes to AI. I'm really, really happy to see the breadth come out with some of these other names. And like you said, healthcare and some of these other sectors that really have not participated a whole lot this year.
I'm so glad you mentioned those AI chips from Google. These are the tensor processing units known as TPUs. From what I understand, they are specifically designed for certain AI-related applications. And maybe more importantly, these chips use less power than NVIDIA's GPUs, those graphic processing units that were originally developed for computer graphics. When it comes to the GPUs, I think there's no mistaking the fact that they are essential now when it comes to various AI applications. You mentioned the report from the information on Meta platforms being in talks to spend billions of dollars on the Google TPUs. So I'm curious as to how you understand this development and whether in your mind it represents any sort of threat to NVIDIA's dominance in the market for these AI chips.
I don't think it does right now. They've got a backlog of roughly 3 years, and there's a lot of people trying to just get their NVIDIA chips. It does kind of bring the question: when does this kind of shift? Right? We've also seen Broadcom perform really, really well. That's another one of our holdings in addition to NVIDIA. We also own Alphabet, so we own all of these names. We don't believe that this is going to be massive, but the market is certainly looking to this to see is there something big that comes of it. The valuations, frankly, aren't that bad when I look at NVIDIA as well as Google, Alphabet, and some of these other names. Palantir seems to be a little bit stretched, but what they're doing with oncology seems to be really, really different than some of the other enterprise-wide application uses for AI.
So, Jim, I'm going to imagine with names like NVIDIA, a company like Alphabet, you have locked in, or seen, I should say, pretty handsome gains so far. Are you tempted to lock in some of that profit now, maybe reduce a little bit of risk, take some money off the table, so to speak?
Yeah, that's a great question. So, I mean, we look at our portfolios from a risk management, position sizing standpoint, and we are constantly looking at, not wanting to take on too much risk. We love these names. A lot of our quant-driven portfolios are capped with a target of 2.2%. And so when these things go from 2 to 3, 3.5, some of the smaller positions have gone even higher. So it's not that we don't like the names, we just don't want to have that much exposure. Certainly a lot less exposure than the index.
So I mentioned the rotation into healthcare as one possibility. Are there other areas of the market that you perceive to be maybe a better value if you're going to reduce some of your exposure to these big cap tech names? Where would you reallocate that capital?
Yeah, so we continue to like industrials, and we continue to like financials, but we've also added some to utilities. We believe that the tie-in with AI and the need for energy and electricity is real, and so there's thematically we're looking at some of those different names, and we don't want to just have everything moving the same, right? So a lot of what we're doing is quantitative driven. So that means we're going to have some momentum, we're going to have some value, we'll have some quality, but we'll also have some lower volatility and some trend reversals, some names that have really gotten beaten up that are starting to come back to life. We like those from a value standpoint, particularly.
Let's talk a little bit about Fed policy, because given some of the data that we had today, I think we had a further cementing of bets on a rate cut at the December meeting. I think the probability right now, if you look at Fed funds futures, 80% probability of a rate cut of 25 basis points. Are you comfortable with that? Are you worried about that in the face of the PPI data today that illustrated that inflation is still an issue? I mean, perhaps the Fed is moving a little too aggressively. I get that the labor market is showing weakness, but as recently as a month ago, there was a lot of doubt about the possibility of a rate cut, given the fact that there was so much debate going on among Fed policymakers, and inflation seemed to be a big worry.
Yeah, I mean, when you look at last week, I think the Fed funds futures were pricing in like 30% or less rate cut for next month, and now we're, as you said, 80%. We believe that that the risks are not perfectly balanced. We believe there's more downside risk when it comes to the labor market. We believe that some of this inflation is owner's equivalent rent that's kind of sticky. There's a lag. It's likely to come down. Certainly the policies with immigration and demographics would indicate that there's some deflationary pressures, and certainly with AI and productivity. The labor market, on the other hand, we believe that this is likely weaker than the data would currently suggest. And so most of the conversations, we're having lots of conversations with lots of other investment managers and experts on this, and they believe that it's better for the Fed to be proactive in cutting rates than to worry too much about the inflation.
Jim, I'm wondering whether there's something to be said for this debate as to whether or not lowering interest rates is the right prescription for the weakness that we are seeing in the labor market. And if you'll allow me, I'm going to cite what we heard from HP Inc. after the bell. The company's going to cut between 4,000 to 6,000 jobs through the fiscal year 2028 by using more AI tools. So, yeah, we're at the point where maybe we're in some sort of regular business cycle that we're familiar with that would justify cutting interest rates. But there's also this new transformative technology that's being embraced. And the reality is it's threatening to reduce the number of workers.
100% agree with that. And, one of the data that I read was an executive over at B of A was saying that, rather than, only a banker only managing 15 client relationships, they could manage 50. And so that means you don't need as many people. Certainly that would be something that would be a concern for the labor market. I would say that is a concern for the probably the larger companies that have tens of thousands of employees. But going back to the interest rates, lowering rates, I think, would help the smaller businesses, especially those businesses where financial conditions for them are a little bit tighter. They're not as profitable as the larger companies, and so that would really help. It would help with consumers some, and so I think that doing that would actually be helpful. That whether the Fed cuts or not probably isn't going to impact the AI story. That this is a fast-moving train that you can slow it down some, but it's not going to stop. And a lot of a lot of these large companies are flush with cash, and it doesn't really matter for them what the rate is. That they can easily borrow.
That's a good point. Jim, we'll leave it there. Thank you so very much. Jim Worden is the CIO at the Wealth Consulting Group, joining us here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.